A common question we're asked is, should I buy my interest rate down? That, for some people, may make sense. So the basic concept of how an interest rate buy down works, let's say that you're getting an interest rate of 4%. That's where the market's at. You could buy it down by paying more in closing costs. Let's say that it's going to cost you, we use the term points, that is 1% of your loan amount. So if you have a $100,000 loan amount, 1 point would be an additional $1,000. So paying an additional $1,000 may get your interest rate from 4% lowered down to a 3.75%. So it does save you in interest. The question that needs to be considered is, how long are you going to stay in the home? Lowering that payment or that interest rate from 4% to 3.75 probably save you just a little over $10 a month. And so the thing we consider is if it costs me $1,000 to save that $10 a month, what's my break-even point? Dividing that out, it's a little over 8 years before you've made that money back. So the real answer is, if you're going to be in the home more than 8 years, perhaps it's worth considering. If you're not, then a buy down may not make sense for you. So an important question, should I buy down or not? It's really understanding that break-even point and setting up that plan of of what your expectations are in the home. In general, my recommendation is if it's taking you longer than 4 years to break even on an interest rate buy down, my general recommendation is not to do that. That's really because people, for one reason or another, refinance or buy a different home, do something to their mortgage every 4.2 years. And it's really a pretty darn good statistic. And so if it's taking longer than that 4 years, I'm typically a little bit more reserved on recommending a buy down. If you can get it under that and you feel that it's a value for your money, then I think it's worth considering.